Olá a todos, eu sou Laura Seabra, do time de Third Party Distribution da BTG Pactual Asset Management. A nossa área desempenha um papel fundamental na diligência e curadoria de gestoras internacionais, oferecendo uma plataforma ampla e diversificada de fundos globais para os nossos clientes. Iniciamos hoje a última entrevista de uma série de 3 episódios com alguns dos gestores que representamos e que estiveram presentes na 7ª edição da nossa Global Managers Conference. Hoje temos o prazer de receber Brett Collins, CPM da Nomura, uma das principais gestoras globais com sede no Japão e que celebra 100 anos de história em 2025. Eles administram mais de $500 bilhão em ativos. A Nomura é uma parceira de longa data e um dos fundos de destaque que distribuímos aqui no Brasil é o US High Yield Bond Fund, um fundo que busca ganhos de capital por meio de uma carteira diversificada de títulos de alto rendimento, majoritariamente emitidos por empresas nos Estados Unidos. Brett, thank you very much for joining us today to discuss this class, which plays an important role in our portfolios. Let's start with the big picture. How do you see the current macroeconomic environment impacting U.S. high yield market?
Thank you, Laura. I'm very happy to be here. Our base case assumption for the U.S. economy is that economic growth is going to slow in 2025. The last 2 years, we've seen the U.S. economy grow at about 3%. This year, we expect growth to slow to slightly faster than 1%. That's actually a fairly favorable environment for the high yield market because growth will likely be strong enough that most companies will continue generating the cash flow required to service their debts. But at the same time, growth is likely to slow sufficiently to allow the Fed to ease incrementally this year and into next year, which provides a tailwind for all fixed income asset classes, including high yield.
And how are companies in this high yield universe navigating the higher interest rate environment?
Well, with high yield bonds, the interest rate is fixed, right? So the higher for longer interest rate environment is much more challenging for borrowers of floating rate assets versus borrowers in the high yield market where they have a fixed rate of return. But one thing that we have noticed is a significantly large amount of issuers have refinanced their bonds early. So while in total yields are relatively high, spreads are tight. So CFOs in the high yield market have been aggressively refinancing debt that matures in the next 2.5 years to lengthen their maturities to again ensure that they don't have any liquidity problems in the near term.
Brett, could you explain the strong horse philosophy and how it shapes your investment approach?
Sure. All of our strategies at Nomura Corporate Research and Asset Management are underpinned by what we call our strong horse investment philosophy. So you think of a horse that has the physical strength to pull a heavy cart across different types of terrain. Those are the types of firms that we seek to invest in. We are looking for firms that have the financial strength to service their debts across an entire market cycle. So a high quality company can certainly be a strong horse, but a CCC rated company can also be a strong horse. But if they have a worse balance sheet, they're going to need to generate much more cash flow to service those debts. So we look across the rating spectrum from the highest quality BBs to the lowest quality CCCs and below, looking for firms that have the cash flow capability to service their debts across the cycle.
And what are the key factors we should look for when selecting good issuers?
So we have a team of 12 sector specialist credit analysts. They are deep experts in the companies they follow and the industries they follow. And when they're evaluating a bond to potentially include in our portfolio, they'll look at the issuer's business risks and some of those strong horse factors that I just mentioned. We're looking for companies that are industry leaders in the businesses in which they operate. We're looking for companies that generate strong, predictable cash flow, firms that have a durable competitive advantage, and a management team that has a track record of success. Our analysts will also look at the financial strength and the economic strength of the company, and they're going to look at the balance sheet to understand leverage, the company's leverage, understand its maturity profile. They'll project earnings and cash flows going forward and better understand how the firm's future prospects look. And our analysts will also assess any security that we're considering holding in the portfolio, and they will look at the protective covenants that are part of that bond deal. They'll look at where the security stands in the capital structure in terms of seniority, any security backing the bonds, and they also look at call provisions.
Where are you currently seeing the most attractive risk-reward opportunities within the U.S. high-yield space, and what are the main risks?
So when we look at the U.S. economy, we do expect growth to slow this year, but we think a recession is unlikely. In a slowing growth environment with relatively tight spreads in the high-yield market, we are very cautious on more economically sensitive sectors. So things like retail, consumer goods, autos, those are areas where we are very cautious. There's certainly opportunities on a credit-by-credit basis in those sectors and industries, but we're cautious on more economically sensitive areas of the market. And the places where we see the most interesting opportunities today are the less cyclical companies that are stable cash flow generators, and particularly US-centric businesses. So the autos and consumer goods retailers, they're much more exposed to tariffs. Companies that are US-centric, US companies with US supply chains selling to US companies are less exposed to tariffs. So the areas we find most interesting right now are things like gas midstream, utilities, food, grocery stores, even cable television companies we think are very interesting, the stronger, more stable cash flow generators in the cable space.
To end, here in Brazil we have a 15% interest rate. Why should a Brazilian investor consider allocating in US high-yield bonds? And what makes the risk-return profile attractive in a global context?
Yeah, so clearly, government bond yields in the mid-teens are very interesting. Real asset rates in the high single digits are very interesting. But there's a lot of uncertainty in the global economy today, whether we're looking at geopolitical events or political instability across various regions in developed and emerging markets. We're looking at economic instability as well, varying growth rates and potential for forward-looking growth rates as well. So there's a lot of uncertainty in the market. And in an uncertain environment, investors' best friend is diversification. So I'm not advocating that investors sell their Brazilian holdings and move offshore, but including part of your portfolio offshore to defend against higher inflation, against deteriorating currency in Brazil makes sense to have a more diversified portfolio with both domestic and international exposure.
Thank you very much, Brett, for being here with us and sharing these valuable thoughts with our investors. Obrigada a todos que nos acompanharam. Para quem quiser conhecer mais sobre a Nomura e sobre o fundo do US High Yield, o nosso time está à disposição. Muito obrigada e até a próxima.